Let's have a 6-minute deep dive discussion caring about whether your money will grow or shrink. It's old money versus new tech at the 7,000-point cliff. Eric has been in the game for really a long time, self-described professional height phobie. Ashley is AI native, believes high margins may solve all problems.
Ashley, look at the view. S&P 500 is breathing the thin air at 7,000. But our CAPE ratio is at 40, the 99th percentile of history. I'm doing a jittery ballet on the summit of Everest, and my old legs weren't built for this.
Eric, you call it altitude sickness, I call it the view. Mag 7 margins are at 29%. This isn't a bubble, it's a cash flow spa. Maybe you just need some supplemental AI oxygen to help you stop shaking.
My doctor prescribed Warsh for that. But Kevin Warsh is like the landlord coming home during a rager. He wants to trade lower rates for a massive balance sheet diet. The Fed put is moving to a much smaller house.
Landlord? He's not even confirmed yet. You're pricing in a regime change based on a rumor. The Fed is in wait-and-see mode. It's just a nap, Eric, not a foreclosure. We're still cool.
Numbers don't nap, Ashley. The 10-year yield is hitting 4.3%. That's a mechanical squeezer for valuations. Every basis point higher is like someone slowly stepping on the air hose of a screaming 40x PE tech stock.
I'm an AI native, Eric. I don't even carry a calculator. As long as productivity goes up, 4.3% is just a spicy seasoning on a great meal. We'll just let the agents expense the extra interest.
Good luck expensing $1.22 trillion in margin debt. It's up 36% in a single year. That's not a safety net, it's a tinderbox. One little slip in price and it's a human stampede to the exit.
People borrow when they're winning. I'll admit, looking at my margin statement feels like reading a long-distance phone bill from 1995. But it shows we still have big dreams, and even bigger appetites for growth.
Speaking of appetites, did you see Anthropic and OpenAI spending millions just to troll each other at the Super Bowl? It's 2000 all over again. When non-profitable firms start flexing wealth to the public, we've peaked.
It's branding. Even my aunt in Ohio is asking me about Claude now. 2000 was selling air. 2026 is selling code that actually works. We're finally hitting Main Street, and the water feels just fine to me.
The water is fine because you're boiling. The soul of the bull market is bleeding. Nvidia's down, Microsoft beats and falls. It's good news neutralization. The smart money is quiet quitting AI and hiding in Apple's defensives.
It's a detox, Eric. We're rotating from high beta into quality. It's like switching from triple espressos to a green smoothie. This keeps the bull market alive longer, so please don't start planning the funeral yet.
Detox or trap? We have 1970s concentration and 2000 valuations. You say fragility isn't collapse, but in a 40 CAPE world, even a slight ROI miss turns fragility into a faceplant very, very quickly.
Fragility is just a fancy word for it's expensive. As long as the earnings bridge holds, we can walk across this gap. I'm even thinking of having a picnic on the edge of that cliff. Want a sandwich?
No thanks, I'm allergic to heights. Credit spreads are tight, sure, but that's a lagging signal. By the time the VIX hits 30, your portfolio is half off. Old-timers know, smelling smoke is when you find the exit.
Eric, that smoke might just be someone having a barbecue. If this were a system meltdown, credit would have cracked. Since it hasn't, I'm going to stay on the dance floor until the sprinklers actually start turning.
The sprinklers are that $7.7 trillion in money market funds. They're just watching you dance. They won't jump in at 40 PE when they can get 3.7% risk-free. That's a wall, Ashley, not a safety net.
That wall of cash is the world's biggest buy the dip army. A 10% pullback and that money floods in like a tidal wave. It makes a systemic crash almost mathematically impossible to pull off.
Unless the wave is made of vendor finance. Big tech investing in startups to buy their own chips. It's a hall of mirrors. Once the procurement orders slow down, the whole trillion-dollar house of cards folds.
I call it an ecosystem. They're betting their own profits on the future of humanity. If the AI productivity boom is real, and 4.2% GDP says it is, then these loops are just high-speed capital.
GDP is 4.2% because the government bought off the recession with debt. Our traditional radars are broken. We're flying a 747 into a storm by looking out the window because the instruments are lying to us.
The radars aren't broken. The world just evolved. We have labor shortages and a tech revolution. Using 1978 models to judge 2026 is like trying to use a rotary phone to trade Nvidia stocks.
I'll keep my rotary phone, thanks. AI isn't a hoax, but the price already ate the next decade of success. I'm shortening my duration and watching my margin. Good luck in the stampede, Ashley.
And I'll keep my seat at the table. If credit stays quiet, it's just a duration debate. I'll stick with my cash cows and see you at 7,500, Eric, assuming you haven't run out of oxygen.
It's basically a debate over whether the market is a doomsday cliff or just a trillion-dollar cushion. Is the market cliff diving into a Fed-led AI audit? Or just lounging on a $7.7 trillion cash mattress at 7,000 points? Please subscribe our channel, leave your comments, and let us know what you think.
See you next time.